Welcome to Your Money, Your Call. It's Bonds versus Equities. I'm Mark Todd from FIIG Securities, and joining me tonight on the show is Steve Goldman from Capstream Capital, and I have Roger Donnelly, who is from FIIG. And we're going to talk about FIIG and what that means to, we have our first economist, which is fantastic. So if you have any questions, please 1300 30 34 35, or the email is yourmoney@skynews.com.au. Welcome. Thanks for taking the time on a Friday. I know that you'd all be the Roosters. Sorry, who's playing tonight? The Bunnies, aren't they? The Bunnies are playing. Is that right? The Bunnies are playing somebody. Right, all my kids just tell me that it's going to be the Roosters that'll win, so just don't worry, Dad. So I'm just, I think it's Manly versus South. They're going to have a crack at it. So we'll have a lot of people taping the show. That's what'll happen. Roger, tell me about FIIG. What's that organisation and
okay, Mark, we tend to fly under the radar screens of quite a few people, so I welcome the opportunity to tell you. In a nutshell, we're Australia's export credit agency.
Yep.
Now, virtually all countries around the world have an export credit agency or an Exim Bank.
Yep.
We're one of those entities, which means that we're in the business of helping Australian companies do cross-border business.
Okay, so it's a government organisation?
We're a statutory corporation, yes, but not budget funded. We're self-funded, which means we're in the capital markets, borrowing money and on lending.
And by that, for the viewers, that means you issue bonds.
We do.
And they would be a government guaranteed bond.
They are. We're AAA rated.
Right. So the rate at which you borrow money is in line with where the government borrows money, around that sort of very low yield. So for the viewers at home, please don't call through and ask for Roger's phone number and buy his bond. That won't be happening. But so you borrow that money and at that very competitive rate, and then whom comes to your door?
Okay, essentially our potential client base are all Australian companies, and by that I don't mean wholly Australian owned, but they can have a large degree of foreign ownership, but with an Australian base.
Yep.
If they're interested in doing cross-border business, and by that I mean export, doing direct investments abroad, establishing supply chains, international supply chains. We can provide a range of financing, guarantee, bonding and insurance facilities. We work a lot with companies in emerging and frontier markets.
Yep.
And we cover the whole waterfront of small, mid-sized and large enterprises.
Fascinating business.
I
think there's a lot of government instrumentalities that exist that people aren't conscious of. I mean, you wouldn't be aware that was around, and the access to that would probably be something you'd have to sort of do a bit of due diligence. And again, not that you're going to go on and say this is the guy to lend the money, but it would be very hard to. You'd have a lot of guys who'd be knocking on your door that probably wouldn't be appropriate as well, I guess.
That happens, but we and to be frank, we're a commercial organisation, so we do need to distinguish between the calculated risks and the reckless gambles, and we do turn people away. But we're very interested to find those bankable projects that the private markets for whatever reason don't fund at the margin that we can assist, and that's the sort of business we're in. We work in close conjunction with our clients' banks and with overseas financial institutions.
That commerciality would be very. I mean, we can't talk about the different political parties, but in this new regime, the coalition would be very happy to hear that. So that's good news that there's a competitive environment. And how are things for you, Steve? How's business with the Capstream model? What's happening with you guys?
It's doing really well now. We're a bond manager, and really our main product is a fixed income product that seeks returns that are a little bit over cash plus 2 to 3%, but while limiting downside volatility. So in the 6.5 years that we've been around, we've had only 4 months where we've delivered negative returns. So in total.
How big is the fund now?
It's 1.5 billion.
Yeah, so that's a nice chunk of change.
Yeah, it is, and a lot of retail money been coming in over the last couple of years.
Has that grown, the level of retail investments? Has that increased? Is it, we keep saying at FIIG that people want the product. We would have between 200 and 300 inquiries a month. So it suggests to me that people want that product. How is it with you guys?
It is. Both on the institutional and the retail side, I think there are kind of two things that are happening right now. One is bank deposit rates, where you used to be able to walk into the bank and get a 6 or 7% TD yield. Now you're getting in the 3% range. So people are looking for alternatives. And also, and this is more an institutional story, but traditional bonds that have a lot of interest rate duration or volatility to them, when you buy 5 and 10 or 20-year bonds, they're a lot more volatile. And people now are believing that bond rates are only going in one direction, that's up, which means returns are going to be down. So they're looking for something maybe a little bit safer in the bond world. So,
and that's because you've got a shorter duration.
That's exactly right.
Is it public? Can you tell people how long your duration is at the moment? Is that something?
Yeah, it's public. We have 0.8 years duration in our
8
portfolio.
months.
Well, 0.8 years, so call that...
okay, 0.8 of 12.
Yeah,
you guys are the mathematicians. You can work
close enough.
That's very short.
It is, and the reason that we have it short isn't really that we're worried about rates going up, although we are. It's more if you have a 2, 3, or 4 year duration, that's equivalent to having about 4% annualized volatility. In the real world, that means you're going to deliver on a monthly basis 30 or 40% probability of a negative return. So that's just too much risk for our fund.
Clearly at FIIG we're a big believer in the direct investment. And it's all about, to be honest, it's all about the education, because that doesn't suit everyone. And part of the problem has always been for the organisations such as yourself to identify the value add. And in this instance, you pretty much identify the value add, because how do you, as a retail buyer of bonds, you can't really get short duration. It is what it is. When you buy a bond, you buy a bond. But how do you get short duration? How do you? Yeah. Because you do participate in. If Roger was ever kind enough to sell you one of his bonds, which you won't, because you won't pay the right price. But in the event that you were to buy a long-dated bond, how do you reduce the duration for the viewers?
So for us, it's easy. We'll do one of two things, but the main thing that we do is we sell futures contracts against that position. And really what that does is, as bond yields rise, they start making money. Now, our bonds might start losing some money, but they also have a yield cushion, so that what you really want to try to do is immunize the portfolio against rises in yields. And you can do that through futures contracts. That's hard for retail investors to do. They can do it, but it's hard. It tends to be expensive.
And you've got to be on it all the time. That bond futures are going like crazy, so you don't want to be doing that. Roger, what drives your business? Have you seen a growth in that business? What do you see makes the drivers for FX?
Well, it's a lot of global economic cycles. The export cycle in Australia, obviously, where the exchange rate is at the moment. Because we're essentially in the tied to the export cycle. But our business can also be quite idiosyncratic. We're involved in some quite large and lumpy projects, like in Mongolia with the Oyu Tolgoi multi-billion-dollar.
With the what?
Mongolia's a new resource investment frontier, Mark. With the big boom in commodity prices, there's been this worldwide search for new sources of supply. As you'd know, there's been a big resource investment boom in Australia. It's coming off a bit now, but it's still very large. But it's not just confined to Australia. There are other frontiers in Africa and Mongolia, and Australian companies, both mining companies that take direct investment positions and the contractors to those miners, the guys who are building the mines and often doing the contract mining, are going into some fairly far-flung places, and sometimes that's with our assistance, political risk insurance or finance.
I love this. So we're in Mongolia. What are we searching in Mongolia for? What are we going to mine? What is the Mongolia?
Well, copper, gold, metallurgical coal. They're very prospective for uranium. There's a massive boom going on at the moment, and as I say, there's a lot of Australian companies.
The viewers at home, Mongolia is the place to be. If I could imagine, we had a contract to service, say, Rio. I'm a new up-and-coming service provider. I'm doing something that they want, whatever it may be. Do I then bring that contract to you? Do I have to show you the contract? There it is. There's a not been easy sign. We've now moved that signature over. We've got the new guy in. Is that what happens?
It can sometimes be before you've actually clinched the contract. Sometimes you've actually signed the contract and you need some working capital to actually perform.
Yep.
But you're tapped out with your bank. We can come in with a guarantee to the bank that expands the credit line available to you. We get on with the contract. Sometimes what we're actually doing is providing the finance that enables you to go in and make a competitive bid to win the contract.
Wow. Look, we'll keep talking about Mongolia more, but we have to leave it there. We'll have a very quick break. If you'd like to speak with any of our experts, please feel free to give us a call, 1300 30 34 35, and then email your money at skynews.com.au.
Out here, success is measured in fractions of a second. So pushing the limit requires a good foundation. Which is why our racing cars are based on our most dynamic sedan, the Volvo S60. Come and drive the S60 to see why we're taking it V8 supercar racing.
Ever since I was a young boy, I wanted to experience everything life has to offer. So I started on my bucket list. I chased all my dreams with Expedia.
Life is a journey in which we're all travelers. Looking to make that great trip with someone. Journeys are made by the people you travel with.
Welcome back to the Bonds and Equities editions of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight on the panel are Roger Donnelly from FIIG and Steve Goldman from Capstream. They're here to answer any of your questions. Feel free to call on 1300 30 34 35, or the email is yourmoney@skynews.com.au, and I reckon we'll probably get more emails through the course of the week because most people will be taping and podcasting. And so for those of you who got taping and podcasting, feel free to send us an email. We'll deal with it through the week. Steve, tell me, what's the biggest worry at the moment? What's in the investment horizon? What's the great concern you might have right now?
Well, as a fixed income manager, we tend to be more bearish and more worrying than
Naturally
most of the world.
yeah.
But so there'll always be
hard at
problems.
dinner parties. We just say, hang on, let's be careful. They go, no, drink more.
Yeah. I'll keep it simple. In the U.S., we're worried about two things. The first is the beginning of the Fed's tapering of their quantitative easing, so buying less than $85 billion a month in government and mortgage bonds. And when they begin that, we would expect to see rates rise fairly dramatically. And they've hinted at it earlier, and that's what has caused rates to rise. Now they seem to have backed off a little bit, but it's coming, and really the question is when. And that kind of excess liquidity that we've seen through the market that's filtered through to equity markets, through bond prices, through really global prices, we will see some prices start to fall in risk assets.
Yep.
And then the second thing that we're worried about is also in the U.S., and that's the debt ceiling limit. So this is more a result of the political impasse between the Republicans and the Democrats, and the risks that the government actually shuts down.
And are you blending the budget and the debt ceiling together? Is that what you mean in terms of that? Or do you think the budget will get worked out and the debt ceiling won't? I'm just trying to understand, are you going to separate them, or would you say, no, it's just the political risk, if you like?
Yeah, it's the political risk. The budget, I think you'll be less worried about. There are a couple things on the budget. First, Congress hasn't passed a real budget in about 4 years.
Yeah.
But the deficit situation actually looks a lot better today than it did in the last few years. So this year, the fiscal year in the U.S. ends at the end of September. It looks like the total deficit is going to be in that $750 billion range, which is a pretty awful number. But over the last 4 years, it's been in more than $1 billion.
Yeah.
So we're a lot better off today. And it's really because the economy's picked up, tax revenues have picked up. That's really the bigger story, is the tax revenues picking up. Spending has been cut, small amount, it's down about 4% over last year. So I think the budget story is going to be okay. Though you're going to have some fights over, the Republicans would like to cut spending and not raise taxes. The Democrats would like to raise taxes, not cut spending.
Yeah.
There'll be some sort of compromise where you get a little bit of both. But the debt ceiling is really the thing that threatens to shut the government down in October.
And I feel I've got 2 points that I want to share with you, Roger. I think one of the ideas is that people were very anxious about the debt ceiling and shutting the government down. Now they're calm about it. They're saying, "Oh, it'll only be for a short period of time." I mean, that's how they look at it, which is quite kind of unusual. And as an economist, what was your take on the sequester? Because I think, to Steve's point, the spending cuts wasn't that significant. But when I read it, it was Obama wrote something that he thought no one would pass, and then the Republicans passed it, and therefore he went, wow, this is crazy. The economy has continued on, and so I think it's emboldened the Republicans, and there are some new Republicans in there, some Tea Party. So my question is, what was your interpretation of the sequester, and what's your thoughts on the debt ceiling, that whole scenario?
Well, I thought it was interesting, Mark, that despite the fiscal drag from the sequester, the private sector, continued to stage a recovery, and that led, as Steve was just discussing, to the modest recovery continuing in the US. Like Steve, I guess we in FIIG are watching the looming fiscal arguments closely. It's not our base case. Again, I think like Steve, we think there will be an 11th hour agreement between all the warring parties that will avert anything but a temporary shutdown. I think there's virtually no risk of a technical sovereign debt default. However, there is the downside risk that the so-called continuing resolution that funds the government isn't passed, and there's a need for parts of government to be shut down, and that could be quite a fiscal drag, of the order of 4% of GDP. And if that's continued for a while, I mean, it would represent a significant drag and quite a setback, I think, for the US and the world. So we do need to keep a weather eye on
self-imposed.
things.
I mean, I think the interesting thing was that Bernanke said to the Congress, don't do this, you must listen to us. And I think the Congress has chosen to ignore him and continued on in their recalcitrant way. But the people who haven't ignored him have been the consumers, and I think the consumers are incredibly cautious. And it's the GFC, it's the whole 9 yards. It's the fact that mortgage markets in the States and that long end has just gone up, and that has meant that refi is dropping. The construction piece that they wanted to have to drag them out of the problems is now not moving in the way they meant. So the consumers are saying, Bernanke's screaming, and the parliamentarians aren't really doing it. That is Bernanke wrong, or was Bernanke right? And I think he's an economist, so you might say he's right anyway. But do you get what I mean? Like he's saying this is really bad, and they don't seem to want to listen.
Okay, it's you that you would not pass. The debt ceiling is kind of a meaningless issue in reality. You've passed the budget. The Congress has agreed what the spending is going to be. The only thing the debt ceiling is to actually write the check to pay for it.
Yeah.
So it's kind of like I bought a new car, and now it's time to write the check, and Congress saying, no, I'm not going to write the check. It's a really stupid issue. No other countries have this debt ceiling issue. I think Denmark has one, but other than Denmark, there is no country that really has this debt ceiling issue. So it's the only thing that could happen with this is always going to be negative. So you should never have this law. There's been talks of getting rid of it. It's in the Constitution, so it's not the easiest thing in the world to get rid of. But you're making an issue where one doesn't need to be. It'll be bad. This has happened before. In 1995, the government shut down for it was 1 or 2 weeks. I can't remember.
This is the Gingrich shutdown.
Yes.
Yeah,
that's
Gingrich
right.
and Clinton.
Yeah. And in the end,
Did Gingrich lose his job as a consequence of that?
Well, Republicans were widely blamed for the problem. There's a lot of other reasons why Gingrich probably lost his job, but
personality as well.
but the Republicans definitely took the blame for it, and I think it would be pretty naive if they went into this thinking that they're not going to take the blame for it again.
So okay, this is the question I've got without notice. Do you analyse the parliamentarians, the politicians in the Congress? Do you have any analysis on those guys? Because I am of the view, the anecdotal feel is that the Tea Party guys did well in the last midterms, and so those people have come in and they don't care about 94. They would like to see a little bit of crash and burn, and if we burn it we can rebuild it. I feel that it's now driven by dogma. Do you do any of the analysis on who's come through and said, hang on, this Marco Rubio, he's pretty crazy. That guy spoke for 21 hours about nothing.
Yeah, look, I think you're at the point where our legislative process is broken, where people are looking out for their own interests rather than the interests of the country. And now you're getting situations where it doesn't make any type of rational sense.
Yeah.
And I'm not saying that Congress ever made rational sense in the past, but this is really doing damage to the world's economy.
And a lot of those guys are just, as you say, positioning for the next election.
They are,
That's right.
yeah.
With a presidential election. We will have to go for another very short break. We'll be right back. If you feel like giving us a call, 1300 30 34 35, or the email yourmoney@skynews.com.au.
Connections. That's what life's about, really. You see that guy? He doesn't know it yet, but to export his coffee from Papua New Guinea to Asia, he needs to talk to that guy.
With business bankers wherever you're doing business, no one connects Australia and Asia Pacific like ANZ.
Connection made.
Engineered to endure with a lifetime guarantee. Tallman's Endure.
Welcome back to the program. If you have any questions on the bonds or the equity markets or Mongolia or anything you like, or US politics, please feel free to pick up the phone, 1300 30 34 35. The email yourmoney@skynews.com.au, and we'll go to our first email for the night. It's from Mark, and Mark writes, given the way the Australian dollar will most likely depreciate in the medium term, is it possible to take advantage of this assumption by purchasing bonds denominated in a foreign currency that also pay a coupon payment in a foreign currency but also receiving Australian equivalent cash spreads for the rates? Thank you, Mark. Can I pass over to you, Steve, as the bond man, and we'll bypass Roger, who will not want to talk about that whatsoever.
Sure. So the answer is yes. If you wanted to buy, say, US dollar denominated bonds that have yields or spreads equivalent to what you can get in Australia, you can do it. It's fairly easy to do. I'm sure FIIG will sell you all the US dollar denominated bonds you want. You can buy some fairly quality pieces of paper that will get you what you are looking for. But I think you need to be careful and not just assume that the Aussie dollar is going to weaken over the medium term.
That was a $64 question.
Yeah.
That's the key. I think, and Mark's question is a good question, but if you take one step back and you say, now, why would you do that? Are you looking to trade credit? And you're trading credit and currency, so you're actually having the double whammy. So, Mark, it's a great question, and it might be something that you may want to do, but often with the people that buy foreign currency bonds at FIIG will do it for another reason. So that might be they've got US assets, they've got US relatives, they've got US, they're retiring, so they've got US holiday expectations, European holiday expectations. So they might buy an Australian credit, Leighton's Ausdrill in dollars, in euro. They'll have a relationship with the bond that has another goal. Now, it might make them a lot of money as a consequence, and they'll be happy with that. But if the currency moves against them, they again, that's not the issue. That's not the reval stroke problem that they've got. So, yes, Mark, you can do it, but you really need to think about why you'd want to do it. That's the key. Roger, can we talk about emerging markets? How is it that emerging markets affect the Australian economy? Because I've had guests on, and they've said, look at the emerging markets. Where are those emerging markets? How do emerging markets tend to affect the Australian economy? Can you give me some sense
in important and increasing ways, Mark. 70% of our exports now go to Asia.
Yep.
Asia ex Japan, it's about 50%. It wasn't that long ago that China overtook both the US and Japan to become our top trading partner. 30% of our exports go there.
Can I just stop you for 1 second? Emerging markets for the viewers at home. Who are emerging markets, broadly speaking?
Okay.
We're talking China, Brazil. Is that what we're talking about?
We're talking BRICS, Brazil,
So
Russia,
Brazil,
India,
Russia,
China,
India, China.
the so-called next 11, the big weighty countries that haven't quite got into the rich person's club. Indonesia, Turkey, Vietnam, the Philippines, all countries with large populations. In Indonesia's case, 250 million people.
Yep.
Vietnam and the Philippines, 80 to 90 million people. Turkey, another weighty country that's been.
Turkey?
Sorry.
How many are in Turkey?
Again, it's a.
If you don't know the number, it's okay. It's not a trick question.
It's a large number. I think of about 40 million or so, and you know they've been growing quite rapidly.
Yep.
Now these emerging markets form the bulk of our trading partners now. So if they sneeze, we can catch a cold. If they prosper and outgrow the advanced economies, and that's good for us. One of the reasons we weathered the global financial crisis so well was that China became our #1 trading partner, and they grew through the global financial crisis very well, even as the North Atlantic was slumping.
But see, when you wake up, you look at the Dow first up, don't you?
Dow, I look at bonds.
It's interesting how it's a cultural thing, because your point is right. I went to a Macquarie Bank presentation, and they were showing all the data, how many Indian millionaires were being created, you know, by the Mint or whatever it might have been, and it was clear that they made the same point. It's all about behaviour. Our behaviour is look at the Dow. The Dow's down. Oh my, this is really bad. As an investor, everyone was thinking that's really bad, but clearly that's not the case. You've got to try and take a longer hoe. You've got to say, listen, let's carve a trench out for a bit longer, and so how long should I be there? What about you with offshore investing? Does Capstream invest offshore?
We do. We're a global bond manager. Until last month, until about 2 months ago, we had about 15% of our portfolio in Asian issuers. They were all investment grade issuers. And
in US dollars?
Most of them were in US dollars. The problem with local bond markets, so Asian bonds denominated in their local currency, is there's such foreign demand for those assets that they're very expensive relative to the hard currencies, the ones that would be issued in US dollars or Australian dollars.
Why is that?
Investors want to buy them. There's just such demand for that paper to have that local currency that they're very, very expensive. And the other thing you got to be really careful about in those bonds is the underlying bond indentures. So the promises that the issuer is making to its investors are very weak relative to the U.S. deals.
And Australia?
And Australia. So if you buy a bond denominated in, say, Australian dollars or U.S. dollars of that Asian issuer,
yep,
you're likely going to have Australian law or U.S. law. So there's good case law behind the deal. When bad things happen, you know what's going to happen and how you're going to get your money back. If you have it in Indonesia under Indonesian law, you just don't know what's going to happen.
Because it's just is that consistent with, well, is that something that you're worried about in terms of the rule of law?
It is. I mean, from my perspective, looking at emerging markets, what I do find interesting is that the fund managers have been shifting at the margin into local currency denominated debt.
Yeah.
And it's the portfolio rebalancing, the capital outflows out of local currency denominated securities that's putting some of the emerging markets now under pressure. Taper talk has prompted.
We all heard about it. I mean, the taper talk meant that India, you're on your own. Indonesia, you're on your own. The currencies got belted. Inflation became highlighted. Reserve banks were going, hang on a second.
But that was withdrawals from equity markets, and it was withdrawals in some cases, for instance, in Indonesia, from rupiah-denominated fixed income.
It happened in Indonesia and rupiah. It happened in the same issuers in U.S. dollars. They sold those deals as well. So it was just capital withdrawal from emerging markets as a result of the taper.
When that was happening, I didn't see that. Where did they put that money? Treasuries?
Yeah,
Treasuries
there's
been
a flight
selling
to
off.
there's always that flight to quality. What happens when money moves out of risk assets?
Yeah.
Goes into
But the Treasuries didn't rally any meaningful way, did it?
No, we're at a lot lower
We're down
yields
25
today.
basis points from the 3. I mean, but for the volume, put it this way. When we spoke about Bernanke and the buying, they buy 85 billion every month. They didn't stop in June. They said, we are thinking about something in September. So they didn't stop, 85 billion. They blew through them from 160 to 3%, from 2% to 4%. And Bernanke and his team would have been saying, hang on, I'm still buying. I'm just thinking. And so when they've said, hang on, here's the taper issues, no one really bought the bonds in a comparative sense, if you see what I mean.
Yeah, look, the money came out of the riskier end of the bond market. They went into, well, you can see what rallied. Treasuries rallied a little bit. Equities rallied. A lot of other things.
Equities they went into the riskier equities.
Yeah.
So we have to go to another short break. But please feel free to give us a call, 1300 30 34 35. The email, yourmoney@skynews.com.au. We'll be right back.
Want rewards that are out of this world? Welcome to the world of yes. Want to go places faster? Yes. Use your points with the choice of airlines to fly where you like? Yes. Last year we helped our card members enjoy over 14 million great experiences by delivering rewards which are faster, smarter, better. Yes. Just part of the Going the Extra Mile service we deliver daily. American Express. Realise the potential.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, Australia's #1 Forex provider.
I'm looking for a little mate of mine who works here at IGA. When I first met him, we just seemed to click. Oh, here he is. G'day, Lockie. Lockie's job is to lock hundreds of prices down to save you more all over the store. So look for the lock and save at the local IGA. Nice one, Lockie. Settle down, mate.
Life is a journey in which we're all travelers. Looking to make that great trip with someone. Journeys are made by the people you travel with.
Connect with Suzuki for the latest technology and outstanding value, like SX4 Navigator with Bluetooth hands-free, audio streaming and satellite navigation from only $19,990 drive away. See your Suzuki dealer and connect with Suzuki today.
Welcome back to the show. If you have any questions about the bond or equity markets, feel free to call us, 1300 30 34 35. The email is yourmoney@skynews.com.au. We have another viewer who has emailed, and the email is from Mark, and he said, the subject is, he's actually given us a strategy here. The subject is a person who's a retiree, age 60 and over, with considerable funds for investment. Is it possible to construct a fixed income portfolio which will have the same duration as the retiree's fixed income expenses or liabilities in the future? If this is possible, would future coupon payments from the bonds be able to pay for the future fixed income expenses, with the added security of not being susceptible to the future interest rate movements, in essence immunising the retiree from future interest rate movements? Is this a method of customisation that you or any of the fixed income specialists use? That is a very long email, but a very interesting email. I'll pass over to you first, Steve. Let's talk about that, because we spoke before we came on about how different countries have got different exposure to this. So what was your thoughts?
Yeah, you could do exactly what the email says. If you're 60 years old, you could buy some 5-year bonds, some 10-year bonds, some 20-year bonds, even some 30-year bonds, that would mature at the time that you need the money. So you could kind of ladder that portfolio so that you'd have cash all through whatever you needed along the way. The trend, at least in the U.S., and I'm much more familiar with what's happening in the U.S. than I am here. There's this concept called target date funds.
Target date funds. Yep.
And basically what they are is, say you're 70 years old or you're 80 years old, your life expectancy is probably 20, 30 years. You probably don't want to invest a lot in equity markets because equity markets could fall 50% like they did in 2008. You lose all your money, you don't have enough money for retirement. So what these funds do is they say, okay, this person is 70 years old, I shouldn't have a lot of equity exposure in this fund. Should be a lot of bond exposure that matures over the next 10 years so that person will, there'll be very little volatility in the returns of that money, and we'll always have cash for that person.
If I'm 40,
you'll have more
clearly I'm almost 40. If I'm 40, I will put the money in, and then I'll put the money on a consistent basis. So as I hit 50, the portfolio will change. The fund manager will change.
The fund manager will automatically change the allocation. When you're 40, you don't really need the money in the next 10 years, so you might as well take a little bit more risk at that time and hope that it grows. But when you get 50, 60, and 70, you need to de-risk your portfolio. So that's what these target date funds do.
And is that a growing segment?
It's massive in the U.S. Maybe 5 or 10 years ago, it didn't exist. It's $500 billion today. It's forecast to double in the next 4 years. I probably shouldn't be marketing other competitors, but Fidelity in the U.S. is probably about 30% of that market. I don't know what they do here, but a lot of big managers have now put those target date funds together.
So at FIIG, we offer portfolio construction, and what we do is talk about that idea, having that Rumsfeld portfolio, I could describe it, the known knowns, the unknown unknowns. And, it's fixed, it's floating, and it's linkers. And to that end, we always think that's the perfect client. The perfect client is the guy that said, I've just come to the conclusion I'm going to have a sense of liability for as long as I live, whether it be travel, school fees, children who won't leave the house. And I need to work out how that plays out, because what we tend to do is say, if you've got $1 million, this is how much you can have. And no one ever thinks, how much are you looking to spend? So one of the things we always ask them to consider is an inflation-linked bond. And we talk about this all the time. We go off and off and off. And people say, for God's sake, find something else. But that's the one that we think everyone needs to sort of get their head around. That's the first one you buy. It doesn't matter where that goes in terms of valuation. That just keeps looking after you. That's the savings bond. And we think if people can get their head around that one, then the rest sort of plays into work.
That's been a big part of my portfolios personally for a lot of years.
Inflation in Australia will be what over the next 5 years? In your
2 to 3%.
Yeah. It's just going to stay there. So people think that's low. That's not low.
No.
A 2 to 3% compounding through the course of your life, from 40s to 65, all of a sudden you can't afford the paper, let alone to buy the printing press. Roger, how does the global economy look?
In reasonable shape, and I think a noticeable feature is emerging markets are slowing down. And advanced economies are speeding up. There's still this big growth differential between the two, but the Eurozone's basically going from a minus 1% growth groove to plus 1%. The US economy's also gathering pace, but at the same time, the emerging economies that have been this powerful growth engine, whilst the North Atlantic was in a slump, they're coming off a bit. It's partly driven...
or a lot? Is it, we're talking Chinese soft landing, that's stopped, it's all happy landing now?
Fingers crossed, yes, that's right. The Chinese appear to have achieved a modest slowdown, and so far, even in the countries that are at the forefront of these capital outflows prompted by the taper talk, countries like India and Indonesia, we seem to be seeing just a gradual growth drag rather than a break. Growth in India is coming off from maybe 5% to 4.5%. Indonesia 6 to 5.5%.
When you read about it, the only thing I'm reading about Indonesia at the moment is that, I suppose Mrs. Bishop's not coming for dinner, but the thing that you read about them is that it's terrible. It's all bad, and you go to Indonesia, it doesn't seem bad at all. But Indonesia and India were at the forefront of all that negative press, and people would have said, "Oh, you know, this is terrible." But these are very small number changes.
I don't think the sky is falling in. I mean, obviously, if there's an acceleration of capital flows, you know, that we could see a further slowdown. I think these countries are far more resilient than they were before the Asian financial crisis. So a lot of people have asked me, are we going to see a repeat of that crisis? I think no. What we do need to keep our eye on, though, is a different set of vulnerabilities that have arisen. When the hot money when monetary policy was being eased in the North Atlantic, that prompted a lot of money to flow into these markets. That inflated a lot of credit bubbles and asset bubbles in these economies. As the money now leaves these countries, and if it accelerates, I think we're going to see some deleveraging and possibly even a credit crunch. You know, so that's, I think, the risk we need to keep our eye on.
Steve, when does the taper take place?
My view, markets right now are thinking in the beginning of 2013. My view is the Fed...
2014.
Sorry, 2014. My view is the Fed can afford...
remember, they come back and haunt you with it, yeah.
We'll go and fix that.
2014, yeah.
My view is the Fed looks where we stand today, that the Fed can afford to wait until later in 2014. The data's good, but it's not that good.
Taper? When does that take place?
I'm inclined to say 2014. There was that coverage of the Governor Bullard saying it could be as soon as next month.
Yep.
But like Steve, I tend to think the Fed will wait.
So if I'm in Indonesia and I'm in India, do I think, okay, I've got 3 months to get my credit bubble unbubbled? Do I think I've got that? Am I spinning wheels really hard to try and go to organisations such as yourself and say, look, we need to get a bit of support or whatever it might be? Look, how are they? Because to Steve's point, he's right. When they actually start tapering, the money that left before was hot. The money that is there now will become hot. It will move. It just can't take pressure. And if you're looking at US rates at 4.5%, 5%, and you're looking at Indonesian rates, wherever they may be, it doesn't really matter. You know, if they're at 10, it's irrelevant. You're looking at 5% nominal. You can probably get some great inflation in the States at that time. Are they working hard now?
They are. I think it's been a bit of a wake-up call, the sell-off, and I think the decision of the Fed to be a taper tiger, as the Economist magazine put it a couple of weeks ago.
They're cute.
They are indeed. I think that's been helpful in buying to policymakers in emerging markets to do things that make them attractive to direct investment. That's, I think, their strategy in many cases. The Indonesians, I think, were a bit careless during the period of easy money in putting a lot of restrictions on foreign investment, making investment in their extractive sector less attractive. For instance, bans on the exports of raw ore. They were trying to promote downstream processing.
Right.
But that actually repelled a lot of direct investment. They're now seeking to lift those restrictions and bring the patient capital in to give these economies ballast so they can weather better further rounds of portfolio capital outflow.
But that's not something you could do. You're looking to pick up bonds that are, you know, liquid, and you're looking to stay in things because of your investors' requirements. You know, you can't say it's a very good, honourable thing to do, but you can't do that.
Well, look, we're probably on the safer end of the investment spectrum. So when I think about Asian issuers, I'm thinking about government-backed or government-owned entities. Korea Telecom would be some of the banks. So they're a little safer position than some of the pure industrials or manufacturers.
Did you ever? Well, we have to go to another break. Look, I'm sorry. This is a really good, interesting conversation. We'll be straight back after a very short break. We look forward to seeing you soon.
I'm looking for a little friend of mine. He works here at IGA. When I first met him, we just seemed to click. Oh, here he is. G'day, Lockie. Lockie's job is to lock hundreds of prices down to save you more all over the store. So look for the lock and save at your local IGA. Nice one, Lockie. Settle down, mate.
Check out King in his new truck. Hey, Ammo?
Yeah, reckons he needs the space for his big f***ing job.
Hey, Ammo! Hey, you good on him.
You'd get your f***ing truck licence.
You don't need one. Maybe we should upgrade.
What the f*** for, mate? We're doing fine.
What? We are?
Stand out from the trade pack with an Isuzu Premium Trade Pack.
Welcome back to the Bonds and Equities editions of Your Money, Your Call. And joining me tonight on the panel is Roger Donnelly from FIIG and Steve Goldman from Capstream. They're here to take any of your calls or answer any of your emails. The call line is 1300 30 34 35 and the email yourmoney@skynews.com.au. And we have another viewer email from Richard, and he writes, Dear panel, what is your opinion on the BT Equity Balanced Income Fund? It has a 7% return and the distribution is paid monthly and is known up to 6 months in advance. Thank you. Equity distribution. What I love is the way they can create a name. The Pink-Winged Balanced Fund. I guess equity balance. I don't know anything about this fund, so I can't offer a genuine. I can offer an opinion around the idea of what you should look for. And Richard, you should look for what they mean by balanced. I mean, if it's an equity balanced fund and it's giving you a 7% return and you know 6 months in advance, they'll probably put some derivatives around so they know where they're at. But two things stand out to me. One, you're in equities, and two, you know, you've got to. I need to know sort of how long you want to be in this, because 7% in this environment is a very good rate, and I need to work out how sustainable that rate is, because that's a high number.
Yeah, the one thing that's, I don't know anything about this fund either, but the one thing that I think retail investors always make is looking at the historical return of the fund, and then making an investment based on what they saw in the past. And if you're looking at that 7% historically, I don't think it has a lot of meaning going forward.
And for me, I mean, nothing against BT. I reckon all these guys do their best. But you look at the fund return from some of the managers, they're just not really that hot. And there's been a report out by Rice Warner talking about the idea that these people with self-managed super funds are doing as well, if not better, in understanding assets that they want and buying and getting the better return than some of the fund managers. It just means that being a fund manager is a tough job. You've got to find the right guy. That's the key to it. But if I look at the equity market right now, the equity market, to everything you're saying, Roger, it needs to be able to find some way to have a PE expansion. It needs to work out how those companies need to expand and grow. And at the moment, you're saying we're seeing some growth in Europe, we're seeing some growth in the United States, we've got a bunch of politicians who can really get that wrong, and we've got people trying to recalibrate entire economies in China, India. So I'm going at the bottom of the capital structure to say I want 7%. I could probably find 6% in the bond market, and I'd say that makes some sense if you have a balance. I mean, so have a crack at that. That's fine if you can do the due diligence. But the reality is, don't be driven by 7. If you want to be driven by 7, be driven by risk. And does it make sense to be in the equity market right now with all my money? Yeah, maybe not so much. Just listening to you, Roger, you've turned me off the equity market a little bit. Just, it's very sensible. Let's talk about fiscal stuff. Will America be able to get its fiscal house in order? I mean, we're going back into that United States, but that seems to be the big key. Are you confident that the US can get that fiscal order together, moving out of the argument, or is it just...
Well, I think we've already discussed how, if you look at the long-term budget projections from people like the Congressional Budget Office, they do suggest that now that the economy is has left recession and is getting back on its feet, albeit hesitantly, the picture is much better. The economy is on a path of debt sustainability. The debt to GDP ratios, longer term, should turn down on plausible scenarios for where fiscal policy goes. There are some entitlement programs that do need to be fixed, but they are eminently fixable. Longer term, I think there's a pretty good outlook. Will things be upset by the politicians shooting themselves in the foot in the short term, and perhaps provoking even another credit rating downgrade, such as we saw in 2011.
Yeah. So, I mean, I'm not trying to rehash the things that we did because there's lots of questions to go through. But what I mean is more. I understand the politicians right now, today, in October, the month of October, they've got a lot of things they need to try and do to work out how to breathe. But I suppose my question is more about, is the fiscal balance right? And what you've said is yes, because when you hear the politicians talk, we're going to smash these programs, and we're going to do this to all these poor people. We're going to, do this behaviour around cutting all these taxes and do it. But is the fiscal number right now? Do you think it's just a question of expansion in the economy?
Well, I think that's exactly what gets the U.S. out of its problems. I think the one thing that you really hope for in your politicians is just that they don't screw anything up. You're never going to look for them to do anything positive. They don't need to. Because if you look, I remember in the year 2000, we were at that time in the U.S. talking about the end of the U.S. Treasury market because the U.S. would be running budget surpluses to eternity.
We had it here.
You ended up having September 11th. You had massive spending on security and wars, and so we're in the situation we are because of a lot of spending that happened since then. But the reality is, what drove the U.S. to that point in 2000 was you had the consumer spending, you had businesses investing, and you had government not screwing things up. We'll get there again.
We love it when governments don't screw up. It's time for another quick break. We'll be back in just a moment.
Out here, success is measured in fractions of a second. So pushing the limit requires a good foundation. Which is why our racing cars are based on our most dynamic sedan, the Volvo S60. Come and drive the S60 to see why we're taking it V8 supercar racing.
Count the number of batteries you rely on every day. Now multiply it by 7.6 million households. As the demand for battery power increases, plan for a positive future today with your own Battery World franchise.
Ever since I was a young boy, I wanted to experience everything life has to offer. So I started on my bucket list. I chased all my dreams with Expedia.
Steve Sidbeck. Welcome back to the show. It's the last segment of the night, so we'll go straight back to the panel to answer the following question. It's an email from Jenny from Sydney, and she says, "Hello, Mark and guests. I have $20,000 I'd like to invest in a fixed income product. How could I do this, and what yield could I expect to receive? I understand that FIIG offers a $50,000 minimum. Thanks very much. Not because we're greedy, but because of costs, I want you to be aware of. And it's around about a $50,000 portfolio. So we're trying to, at the moment at FIIG, we're doing $10,000 bonds because we think that's the right number. I think at the moment we've got about $1.7 billion in fixed income on behalf of clients in custody, which we don't charge. And so there's that trade-off between how do we, that process is $1.6 billion in coupons, advices. The operations team are sweating every day. Jenny, I think it's probably a good idea to invest in fixed income, obviously, but I also think it's a good idea to find the right fund manager to work out how to do that. So you should have an advisor that you can trust and talk to. Who'd be a good fund manager that Jenny could invest with, other than?
Yeah, well, I won't mention ourselves, but what I'll say is there's a lot of good fixed income managers out there that you can look at that cater exactly for these type of investments. But the first thing you got to look at is what type of bond fund do you want? Do you want one that's going to take a lot of interest rate risk? Do you want one that has a little interest rate risk? Do you want one that takes credit risk?
Yep.
Do you want one that takes emerging market risk? Do you want one that takes high yield risk? So
we're in our last 2 minutes. So Jenny, the idea is that, as Steve said, just work out what your risk appetite is, but do a little bit of research and do a bit of reading and find that advisor. Go to them and say, come back to me with the right answer. Your expectation should be around about a 6% return, and that should be quite conservative. Don't go too crazy on that sort of stuff. We'll be wrapping up soon, but I want to ask, how does the Fed get interest rates down? The Fed said they're going to do it. forward guidance, the market said, watch this. That proved differently.
Well, through good communication, Mark, and of course there have been some glitches there recently.
Clearly.
And of course it has to be realised that when the recovery becomes firmer and some of those benchmarks they've put out there are breached, the 6.5% unemployment rate, the 2.5% inflation rate, the Fed will actually want to raise interest rates. It'll actually move from tapering to.
But it won't be doing that anytime soon.
No, I think that has to be realised.
They can't cope.
No.
Look how hard it took to make a move when we had to lower the rates. They won't take a hit. They won't take a movement up. They'll just go like tortoises, lose their head. How does the Fed get rates down?
Well, the Fed has done a good job of keeping rates low over the past 5 years. I mean, they're spending $85 billion a month to keep them down, and even that at this point seems to be.
When they taper, that's what I mean. When they taper, they want rates lower. They want to separate interest rates from tapering. So how are they going to do that?
When they do, as soon as they begin tapering, I'm assuming the reason that they're going to begin tapering is because the economy is doing better. Where rates are today is not consistent with an improving economy. So rates will eventually move up. The Fed, I don't think, will hike rates for the next 2 or 3 years, but mortgage rates are going to go up as the growth story improves.
We'll have to look at the consumer to see how they perform. That's all we're going to have time for today's show. Thank you very much for our guests. It's been a great chat. Roger Donnelly from FIIG and Steve Goldman from Capstream there. Thank you to all the viewers for your emails. Until next time, I'm Mark Todd from FIIG Securities. Have a great night. Go the Bunnies.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
It's really nice.
Rita.
She's wearing my jacket. Wow.
If you're thinking you've found the one, chances are someone else is thinking the same thing. Oi!
Ben?
Yeah. With ANZ Buy Ready,
That Ben.
you'll have approval